Elon Musk just made one of the smartest moves in Tesla's history, and almost nobody noticed. During the silver market pullback in late 2025, when prices dropped from $32 to $28 per ounce, Tesla allegedly stockpiled 18 million ounces of physical silver. That's 560 tons, enough to cover 5 to 10 years of production. Every Tesla vehicle uses 25 to 50 grams of silver in electrical contacts, circuit boards, battery connections, and motors. At 2 million vehicles per year, Tesla needs 50 to 100 tons annually. Add Tesla Energy's solar panels and power walls, another 60 to 100 tons per year. Tesla just locked in supply at $28 while silver is heading to $60, $80, maybe $100. This is not just smart procurement. It's a bet that industrial metals are about to explode. This is the story Wall Street isn't telling you. Tesla didn't just buy silver to make cars. They bought it because they see what is coming. A supply crisis in industrial metals that will cripple every automaker, tech company, and manufacturer that didn't prepare. In the next 13 minutes, I'll show you why Tesla stockpiled 18 million ounces, what it means for silver prices, and how you can position yourself before the squeeze. Hit subscribe and turn on notifications. Tomorrow I'm releasing the silver shortage, how to buy before 100. Let's go. To understand why Tesla stockpiled silver, you need to understand silver's role in electric vehicles and renewable energy. Silver is the most conductive metal on Earth for both electricity and heat. It's irreplaceable in high-reliability electrical contacts, circuit boards, and photovoltaic cells. Every Tesla vehicle contains approximately 25 to 50 grams of silver, depending on the model. The silver is used in battery management systems, power electronics, electric motor contacts, charging systems, and the dozens of circuit boards that control everything from autopilot to infotainment. At Tesla's current production rate of approximately 2 million vehicles per year, the company requires between 50 and 100 tons of silver annually, just for automotive production. But Tesla isn't just a car company, it's also Tesla Energy, which manufactures solar panels and Powerwall battery storage systems. Solar panels are among the most silver-intensive products in existence, using approximately 20 grams of silver per panel in the photovoltaic cells that convert sunlight to electricity. Tesla Energy's solar and storage business consumes an additional 60 to 100 tons of silver per year. Combined, Tesla's total annual silver demand is between 110 and 200 tons. The alleged purchase of 18 million ounces, approximately 560 tons, represents 5 to 10 years of forward coverage at current production levels. This is an enormous strategic stockpile. Why would Tesla do this? The answer lies in supply chain strategy and commodity price risk. After the COVID-19 pandemic and the 2021-2022 semiconductor shortage that crippled auto production globally, Tesla and other manufacturers learned a painful lesson. Just-in-time inventory is fragile. When supply chains break, production stops, and no amount of demand matters if you can't source components. Tesla has since adopted a forward-buying strategy for critical materials. The company has locked in multi-year supply contracts for lithium, cobalt, and nickel, the key materials for batteries. Now, they've extended that strategy to silver by purchasing 18 million ounces during the late 2025 price dip when silver fell from $32 to around $28. Tesla locked in a cost advantage and guaranteed supply security for the next 5 to 10 years. This move also hedges against the silver supply crisis that's unfolding. Global silver demand is approximately 1.1 billion ounces per year, while mine production is only around 880 million ounces. The structural deficit of 220 million ounces per year has been filled by above-ground inventories, but those inventories are depleting. Industrial demand, driven by solar panels, EVs, 5G infrastructure, and electronics, accounts for over 600 million ounces annually and is growing at double-digit rates. At the same time, COMEX-registered silver inventories have collapsed from 80 million ounces in 2023 to just 45 million ounces in late 2025. Physical premiums are rising, delivery delays are stretching to 8 to 12 weeks, and the paper-physical disconnect is widening. Tesla sees what's coming, a supply squeeze that will send silver prices to $60, $80, or higher within the next 12 to 24 months. Here's the unfair part. While Tesla and other sophisticated industrial buyers are stockpiling silver at $28 to $32 per ounce, retail investors are being told by financial advisors that silver is too volatile, too speculative, and has no place in a diversified portfolio. Mainstream media mocks silver bugs and dismisses precious metals as relics. Meanwhile, the world's most advanced electric vehicle manufacturer just bet $500 million that silver is going significantly higher. Retail investors who followed conventional advice and stayed out of silver missed the run from $18 in 2020 to $32 in 2025, a gain of 78%. Now, as industrial giants like Tesla hoard supply, retail will chase at $50 or $60 after the move has already happened. This is information asymmetry by design. Keep retail investors out while institutions and corporations lock in supply at low prices. At the same time, competitors who didn't stockpile silver will face supply shortages and cost inflation. Ford, GM, Rivian, Lucid, and Chinese EV makers will compete for dwindling spot market supply, paying whatever price is necessary to keep production running. Tesla, by contrast, has locked in $28 silver for years. This gives them a massive cost advantage and margin protection that will show up in earnings, while competitors suffer margin compression. Let's break down the numbers. If Tesla purchased 18 million ounces of silver at an average price of $28 per ounce, the total cost would be approximately $504 million. For a company with over $26 billion in cash and marketable securities as of Q3 2025, this represents less than 2% of liquid assets, a manageable strategic investment. At 18 million ounces, or approximately 560 tons, Tesla has secured enough silver to produce 2 million vehicles per year for 5 to 7 years at current usage rates of 25 to 50 grams per vehicle, plus coverage for Tesla Energy's solar and storage production. This assumes no expansion in production. If Tesla scales to 3 million or 4 million vehicles per year by 2030, the stockpile provides proportionally less coverage, but still represents a significant hedge. Silver prices fell from approximately $30 per ounce in mid-2025 to around $28 per ounce during a brief correction in Q4 2025. If Tesla executed purchases during this window, they bought at a local low. As of early January 2026, silver has recovered to around $32, meaning Tesla's position is already showing an unrealized gain of roughly $72 million, a 14% return in a matter of weeks. More importantly, if silver rises to 60 per ounce over the next 18 months, a scenario many analysts consider probable given the supply deficit and industrial demand growth, Tesla's stockpile would be worth $1.8 billion, representing an unrealized gain of $576 million. If silver reaches $100 per ounce in a supply crisis, the stockpile would be worth $1.8 billion, a gain of nearly $1.3 billion. Beyond the financial gain, the strategic value is even greater. Securing 5 to 10 years of silver supply eliminates price risk and supply risk, allowing Tesla to maintain stable production costs while competitors face volatility and potential shortages. Corporate stockpiling of strategic materials is not new. In the 1970s, during the oil shocks, airlines that hedged fuel costs or secured long-term supply contracts survived while competitors went bankrupt. In 2008, companies that stockpiled copper and steel before commodity prices spiked gained massive cost advantages. More recently, after China imposed rare earth export controls in 2010 and again in 2025, companies that failed to secure alternative supplies or forward inventory faced production halts and cost explosions. Those that prepared, by stockpiling or securing long-term contracts, maintained production and protected margins. Tesla learned from the 2021 semiconductor shortage when the global auto industry lost an estimated 11 million units of production due to chip shortages. Tesla weathered that crisis better than competitors because they had secured chip supply through direct relationships with semiconductor manufacturers and had redesigned software to use alternative chips. Now, they're applying the same forward-looking supply chain strategy to silver. The pattern is clear. In a world of supply chain fragility and commodity scarcity, the companies that secure strategic materials early win. Those that rely on spot markets and just-in-time inventory get crushed. 4 signals to watch. Signal 1. Watch for Tesla to disclose silver inventory in their 10K annual report or 10Q quarterly filings. Public companies must disclose significant raw material inventories. If Tesla reports a large silver position, it confirms the stockpiling and validates the supply crisis thesis. Signal 2. Watch for other automakers, Ford, GM, BYD, Volkswagen, to announce strategic materials stockpiling. If competitors follow Tesla's lead and begin hoarding silver, lithium, and rare earths, it confirms an industry-wide recognition that supply chains are broken and prices are heading higher. Signal 3. Watch silver prices. If silver breaks and holds above $40 per ounce, it confirms the next leg of the bull market. A move to $50 would signal panic buying and supply exhaustion. Above $60, we're in full crisis mode. Signal 4. Watch COMEX registered silver inventories. If they fall below 30 million ounces, it signals imminent delivery stress. Below 20 million ounces would likely trigger forced cash settlements, price spikes, and a disconnect between paper and physical markets. The fundamentals are undeniable. Global silver demand is 1.1 billion ounces per year. Mine production is 880 million ounces. The structural deficit is 220 million ounces annually. Industrial demand accounts for over 600 million ounces and is growing at 8% to 10% per year, driven by solar panels, EVs, 5G, and electronics. COMEX registered inventories have collapsed from 80 million to 45 million ounces. Physical premiums are rising, delivery delays are stretching, and supply is tightening. Tesla produces 2 million vehicles per year and growing. Each vehicle uses 25 to 50 grams of silver. Tesla Energy produces solar panels and batteries using additional silver. By stockpiling 18 million ounces at $28, Tesla locked in supply for 5 to 10 years and hedged against a coming supply crisis. If silver goes to $60 or $100, Tesla saves hundreds of millions in production costs, while competitors face cost inflation and potential shortages. Risk 1. If you're not holding silver, you're exposed to the same supply risk that forced Tesla to stockpile 18 million ounces. Industrial demand is structural and non-discretionary. Prices are heading higher. Risk 2. Paper silver ETFs like SLV may not track physical prices during a shortage. In a delivery crisis, physical ownership is king. Risk 3. Silver is volatile. Even in bull markets, corrections of 15% to 20% are normal. Don't use leverage. Accumulate physical on dips. Smart play. Follow Tesla's lead. Buy physical silver, coins, and bars during pullbacks. Dollar cost average. Hold for the structural move to $80 or $100. Wall Street will tell you Tesla's stockpiling is just routine procurement, nothing to see here. They'll say silver is volatile and speculative. Meanwhile, the world's most advanced manufacturing company just bet $500 million that silver is going significantly higher. Trust actions, not narratives. When Elon Musk hoards silver, pay attention. Scenario 1, 50% probability. Silver supply squeeze drives prices to $60 to $80 per ounce over the next 18 months. Tesla's stockpile generates $500 million to $900 million in cost savings and unrealized gains. Competitors face margin compression. Scenario 2, 30% probability. Massive industrial demand plus investment inflows send silver to $100 or higher. Tesla's position is worth over $1 billion in gains. Supply crisis forces production cuts at other automakers. Scenario 3, 20% probability. Silver consolidates between $30 and $40. Tesla's hedge breaks even, but ensures supply security. No crisis materializes in the near term. Timeline. Watch Q1 and Q2 2026. If silver breaks $40 and holds, the move to 60 plus accelerates. Tesla stockpiled 18 million ounces of silver at $28 during the late 2025 dip. That's 560 tons, 5 to 10 years of supply. Each Tesla uses 25 to 50 grams of silver. At 2 million vehicles per year, plus Tesla Energy Solar, they need 110 to 200 tons annually. Global silver deficit, 220 million ounces per year. COMEX inventories collapsed from 80 million to 45 million ounces. Tesla sees a supply crisis coming. Watch 4 signals. Tesla discloses inventory, competitors stockpile, silver breaks $40, COMEX below 30 million ounces. Follow Tesla's lead, buy physical silver now. Subscribe for tomorrow's The Silver Shortage, How to Buy Before 100. Comment, are you buying silver? Let's go.